presentation. This is not about you getting to do something. This is about you. So as we go through the different topics about giving, if there's anything you want to, ask a question right then and there, and we'll deal with it. Okay. So, going to the next slide. Okay. So, what is charitable giving? So we'll all share into this. It's the act of donating what? Money, goods, time to a nonprofit organization or cause to support the organization's mission. Okay? It's simple as that. And it can be a strategic part of your financial and estate planning. How? Well, we'll get to that. Okay? And it is the act of giving to create positive changes regardless of your wealth or your status. Ways to accomplish the charitable giving. And if you want to, again, everything is outlined for you. You can make notes and you can kind of highlight it. But you can do it through your retirement account, an investment account, your will, trust, life insurance, okay? And we'll be discussing each one of those individually as we go through the slideshow here, okay? We have a qualified charitable distribution. This is the way to give through your retirement plan. So is there anybody here that is age 70 and a half now, but not 73 taking RMDs or required minimum distribution?
Get ready.
Yeah.
Okay. So is there anybody here that's going to be 70 and a half next year? Okay. All right. So.
How about 73 next year?
No, 70 and a half.
We'll get to that.
Oh,
Okay. All right. So if you're getting close to, let me tell you what the key here. If you're getting close to where you're going to be age 70 and a half in a year, you can go ahead and you can donate money directly out of your retirement account to a charity, and you don't have to claim it on your income tax as income. That is a big deal when it comes to where you are with Medicare and how they calculate that kind of an income. And also, it keeps you out of that next tax bracket, okay? It's better to do that than to take a charitable deduction on your income tax, because that means you have to claim the income first before you can take the deduction, all right? So it's always better. And the government has allowed the people who are 70 and a half or older to make a qualified charitable distribution from their retirement account up to this year $108,000, and in 2026 it goes to $115,000. Okay? So, any questions yet? Okay.
I do it.
All right, you have a question.
Okay. What will happen if you already retire, you don't work? Can you still do it? Or
No,
you have
not
to-
until you have to. It's the age. The age is important.
And even though you don't work, but you at that age you can do it.
Yeah, at that age is when you can take money out of your account and send it to a charity without having to claim it on your income tax. Okay? It has to be a direct distribution to the charity. Yeah, and it's from an IRA. It can't be from a 401k. It can't be from a 403b. It has to be through an IRA account. Okay. Yes, sir.
You would contact the agency that's managing your retirement account, ask them to transfer certain times every year.
Well, you can do it. You don't have to do a certain time every year. You can do it, at different times whenever you feel led to do it, or how much you feel led to do, or you can set it up on a systematic distribution. Okay.
But it's through the company that's managing your.
Right. It has to be done through them. They have to basically, for instance, we do it out of our retirement account, and we can do it by going into our account, and there's a format that you can follow, and you can distribute the money directly to the charity. Okay? So it depends on how much access you have in your own account. I'm assuming that you can get online, look at your account, look at the performance. There may or may not be a place for you to do distributions on your own.
Right.
Okay. Right. And the problem with doing it on your own is your advisor probably won't know that you're taking money out, and it will affect the balance of your account, how it's invested. And the other thing is you got to make sure you have enough cash and you're using the right account or the right sector or the investment that's in there. Okay, so yeah, you might want to check first.
And another question, would you need to know the number or the 401, what is the 501c number of the?
You would need to know the address, and basically you do it all the time.
Repeat the question.
The question was, should I approach my advisor and let him know that I want to do something about sending money out of my retirement account? And if and the answer to the question is yes. And do I need to know much about the 501c3? And the answer is you need to at least know.
Okay, the name of the organization.
Sure.
And the address and phone number.
Okay.
You don't need the EIN number. No.
Yeah.
Typically you don't need that.
Yeah. And we always like to memo it so that we know, and we always get in touch with the charitable organization, let them know that to expect something from us, because sometimes they just come in with the investment name on it and the payable to, but there's no memo saying it's from, John or Ralph or Don or Kevin or whatever. Okay, so.
Yeah, that's important. The memo is important because Park and I count some of the money, the donations and that sort of things, and we get in checks from a retirement account, but there's no name of whose retirement account it's from, so then we don't know who to give credit to. So it's important to do that.
Okay.
Now, if you are if you've already started taking required minimum distributions, or if you're going to be turning age 73 and it's the first time that you're going to be taking those distributions, the same applies. You can now do it through your retirement account and reduce the RMD requirement. So let's just say that your retirement account says that this year, based upon your January 31st account balance and
December 31st.
December. Did I
You
say
said January.
December 31st. Thank you. And there's a formula that the government has. It's all printed out. It's a table, and you can divide. There's a divisor factor, and we'll tell you exactly how much you are to take out of your retirement account. You can use all or part of your required minimum distribution to go directly to a charity. It does not then come out of the QCD, okay? Now let me explain that, because what happened to us is that we had accomplished most of the distributions to charities out of my retirement account. And there was a couple pennies left over that we were going to, send to different places. And in the block that says required minimum distribution, there is another one that says qualified charitable distribution. And Eunice clicked the wrong box when she was doing it, and it came out as a qualified distribution to a charity, and it did not reduce the need for me to take out the additional money as a required minimum distribution. So we're going to end up taking some more money out of the account than what we had to take out, but that's what happens. So you have to earmark it that it's from your required minimum distribution. So let's just say you had to take $40,000 out. You have to deduct the $40,000 from the 108. That's the remaining balance that you can send to the QCD. Now, you can take money out above that, but it's not going to qualify as a charitable deduction. Okay?
And your
Question,
income.
Bart.
Yes, sir.
I have a 457 account, and does that have to be switched over to an IRA first?
Yep.
Or you can-
Yep.
You cannot take out 457 directly into.
Yeah, the 457 it's a government program, and that is, and I don't know how long you stopped contributing it to it, but your financial advisor probably should be aware of that, unless you don't have one.
You don't have one.
Okay, all right. Okay, well then I can help you out. And not as a financial advisor, just as somebody who knows what to do.
Right.
Okay? Can I talk to you after?
Sure.
Okay, all right. Because the minute you said that, my mind starts going, and I got about 300 questions to ask you, and that's just the way. I spent 41 years doing this, so the brain goes in a different direction. Any other questions so far about retirement accounts? Yes, ma'am.
I just want to double check, these are all federal requirements, correct?
Yeah,
IRS.
yeah, yeah, yeah. There are no state requirements.
Okay.
Yeah,
I'm newly retired, so I'm not guessing.
yeah, yeah. And your retirement was it from any kind of like a teaching institution or anything like that?
No, from the U.S. Marshal Service. Was a government retired.
So you had like probably a 457 or a
Cashed it
403B.
all in.
What's that?
I said, I cashed it all in, it's with the financial advisor at this point.
You just rolled it over. You did,
Well,
yeah. Okay. Yeah. You just switched the format to it. Yeah. Yeah. So you're definitely in an IRA account. Yeah. Okay. Other options for charitable giving. You can do that through beneficiary designations on any of your accounts, including your retirement accounts, and I'll get to that. So you just name the charity. The charity is the beneficiary. You can leave a specific amount. You can leave a percentage amount. Now, what forms might that take? Go ahead in the next slide. Okay.
That's
You-
none.
huh?
This is none.
Okay. This is through a non-retirement investment account. You can do appreciated stock. So if you have stock that you've invested in a company and you understand that if you've made a lot of money on it, so you bought it for 10 and it's worth 100, instead of cashing it in and writing a check out to the charity, you can transfer the stock to the charity, thus eliminating $90 of capital gains just on that stock. Because now the charity can cash it in and they don't have to pay the capital gains. So you avoid the claiming of the capital gains on that stock. Okay? It's a great way to transfer appreciated stock and get the full discount on your income tax of the $100, not the $10 that you paid for it. Okay? Any questions? Yes, Rose.
So is this age-based as well?
No.
Or could I do it now?
You could do it. You could be
Okay.
12 years old and do it.
Okay.
Okay? So it's yeah. That's and then yeah. That's a if do you have a financial advisor?
I do.
Okay. All right. Yeah. He can help you out.
Okay.
All right. It's a common thing for people who have owned stock for quite a long time, and it's not in a retirement account. And if you give money to a charity at all, you want to do it from there first rather than from your checkbook. Okay. Now that can be stock, exchange traded funds, mutual funds, bonds. Okay. Again, it's transferred directly to the charity, and I already went over the capital gains thing. Okay.
Did you say it must be held at least 1 year?
Yeah. Thank you. You have to have a long-term capital gain to do it. So you have to hold the stock 1 year and a day. Okay. So if you've owned it for a long time, you're fine. If you've owned it for 9 months, wait 3 more months. Okay. The other thing I wanted to say is there you can do not only appreciated stock, but you could leave you could transfer a car, any kind of tangible property to a charity as long as that charity will take it. I know the radio station that we
Oops, sorry, I screwed up.
can you get back?
Yes, sir.
Okay. So there's a radio station that we supported up in Bangor, Maine, and they would take campers and boats and cars and everything because they had a market to sell it. They knew that they were going to be able to get it. The nice thing about it is you can take the full value of the fair market value. So you can get an appraisal on it, or you can look at Kelley Blue Book and take the highest value. You can ask the charity to give you a receipt, and they will. And now we're on to I'm not sure if anybody's going to be interested in this, but there are funds called donor advised funds. And if you don't want to give to the charity right now, but you want to do it in the future, and you know that you're going to allocate money to that charity, but you're not quite sure who you want to give it to, you can invest money into a donor advised fund. They will keep the money in the fund, an investment. When you transfer the money into that fund, you get the tax deduction right away. It will build and grow, and then you can leave it to a charity. It's for people who know they want to be leaving money to charities, but they're not sure which ones and how much. So you can establish a fund that gets it out of your account. It'll grow, and you can assign it to the charity in the future. Okay, so it's like an investment account specifically designed to benefit charities. Once it's in there, you're not getting it back out. Okay?
Question.
Yes.
So, like you have to take the money out when you're 73, right? Can you put part of it and start this one too? Does it work or no?
You can, yeah.
Okay.
Just understand that if you want to benefit a charity, what you're doing is you're saying, oh, I want to benefit them, but not right now.
Yeah.
Okay? So you can build up an account for them. All right? Yeah.
So not right now could mean when you die? In a will?
Yeah, well, you can, well, if you're going to do it in a will, I'll get to that. So maybe,
Hold that question.
yeah, so, well, yeah, hold that question, but you might want to ask it again if I don't answer it later. Okay? All right.
I have a question.
Yeah.
What happens to a donor advised fund if you die and haven't designated a charity?
There you go. Thanks.
Good idea.
Yeah, yeah. Yeah, you better leave a note in your will then. Yeah, that donor advised fund that goes there. I would believe that there's going to be if you die, okay, kind of a deferment on there, which is what we're going to get to in the will. Okay. Yeah. And if you knew my notes, it says, if anybody was interested, we would talk later, right? So yeah, you had to throw that one out there, right?
It just came up.
I know, thanks. Why not today when anyway. Okay, so beneficiary designations, that assets that pass outside the will. So you have a retirement account. If you're giving money on a annual basis or a monthly basis, however you want to, out of your retirement account, you can leave a beneficiary designation that says, if I pass away before I, make these donations, I want so much of my account to go to them, 10%, 20%, $20,000, $50,000. So you can do whatever you want to, so that your giving doesn't stop just because you did. All right. You can take a life insurance policy, and you can take and put a contingent beneficiary or even a primary beneficiary as a percentage. So if you had a $100,000 policy and you want to leave $10,000 to a charity, then it would be 10% and 90% would go to your spouse or your children or whatever. Okay? So you can designate through a beneficiary designation. You can even do it with a bank or an investment account. So you can go to the bank and say, I have a savings account. At my death, I want to transfer or on death or paid on death to this charity out of my account. Okay? So it automatically bypasses probate because it's a beneficiary designation. So it's not part of your probatable estate. The same with an investment account. You can do that. You can say, I have a non-retirement investment account, and at my death, I want so much of it to go to this charity. The nice thing about it, again, charity gets it. They don't have to pay the tax on it. Right? You leave it to your heirs, you're going to pay some tax. Okay, through your will, you can leave a gift right up front in your will that says, after all the expenses have been paid in my estate, I want to take and I want this to go before anything else. I want, $10,000 to go to this charity, or $20,000 or $5,000, whatever you want to do. You can leave a percentage bequest of the residual assets, which says that after everything is sold and I've got this stash of money from the sale of my assets, I want to give 10% to the charity, 50% to my son or daughter, and just go right along in that order. So you can do it through the will. And it can be, again, like I said, before all other distributions or part of all the distributions on the residual estate. The contingent bequest. That's a fail-safe that says if all the beneficiaries that I have selected somehow are not alive, and I haven't adjusted my will, then it all goes to a charity of your choice. You can go to anybody else, but I mean, that's what it's an all, so if all fails, this happens. Any questions so far? Did I answer your question yet?
Yes.
Okay, all right. And you want to repeat the question then, so I know what I said.
I don't have that kind of memory.
Oh, okay. But it did get answered?
Yeah.
Okay, good. If you have a large estate, you can go to an attorney and have a trust designed, which is called a charitable remainder trust. The donor, you transfer property, cash, or other assets. That's why you do it through an attorney, because you might have other assets that you're transferring over that are not IRAs. They're just, they could be house, could be whatever. The donor beneficiary receives a stream of income for a determined period of time. That time is generally based upon a remaining balance that has to be left in the account to go to the charity. So if you need a stream of income, you would get that income until the balance of the account reaches a pivot point that it then stops your stream of income and it goes to the charity. That's what makes it legal. That's what makes it that you can go ahead and get a charitable deduction for leaving that money in there, okay? Charitable Elite Trust is just the opposite. You don't get the stream. You receive this income until there's a remainder of assets specified. This one, you receive the income stream for a set amount of years to the charity. So, and then the heirs receive the balance. So this is, you get it first, the balance goes to the charity. Charity gets it first, the balance goes to the heirs. Generally large estates that need to take and get the charitable deduction. Okay. You can purchase an annuity through that trust that would satisfy the requirements and all the paperwork. What that does is it saves the fees that would be charged by a trustee to manage all those other assets. So it's a cost savings if somebody wants to do it. Other than that, people transfer items into a trust. Somebody manages that trust. They get paid to manage the trust. There's tax filings on it. So it, again, like I said, it's for large estates. Through life insurance policies. I don't know how many people still have a life insurance policy at our age, but if you do, or at any age, and for those who are going to listen and see this later, you can leave part or all of a life insurance policy to a charity. You can also transfer a paid-up policy to a charity. So if there's no need for the life insurance that you have, and it's paid up, and you're just looking to say, well, somebody's going to get it when I die, you can transfer it to the charity. And you can take the full tax deduction of the value, not the death benefit, but the actual value of the policy or the premiums that you paid. So you add up all the premiums you paid, you can take that as a deduction, or you can take what they call the surrender value of the policy as a deduction on your tax, and you can give it to charity. We've done that before for people, and what you can do then is if you have a life insurance policy that's not paid up, you can actually transfer the policy to the charitable institution. You still remain the insured. They're now the owner, and you can make your annual or bi-monthly or whatever contribution to the charity as a tax deduction for them to use to pay the premium on the life insurance policy. Okay? So you get a tax deduction. You get to help them out by supplying the money for them to continue to pay for the policy. And at your death, they get the value of the policy.
Now, does any of this involve, say, with an insurance policy, I die and I'm leaving my estate to a charity? Is proof of death required, a death certificate at any time for any of these transactions? Does someone need to present?
Well, hopefully when you transfer the policy to the charity here, you're still alive.
Yeah,
No.
right, so that is.
Yeah, but at your death then, since they would be the owner, they would get notified that you no longer exist, and
Right.
then they would need to apply for a death certificate from the estate. Yeah.
Did you want to give the example?
Yeah. So one of my clients had a life insurance policy that they didn't need anymore. It was about $250,000. And they thought that would be a nice gift to give to their alma mater, okay? And you can do that to a school because they supposedly function as a nonprofit organization. And so we transferred the ownership of the policy over to the school. He continued to make contributions to the school. They paid for the policy, but there was value in the policy. And as of this date, they have borrowed $80,000 out of that policy for their use, okay? And that helps them out, even though they had, and they know that they're gonna get a death benefit minus the 80,000, so, you know, but they've already used that for some purpose or some reason. And that's the wrap up. Can be done in many ways, as we've discussed. You just need to determine what avenue is best for you. Contact your financial advisor, clearinghouse, or attorney, whoever manages your investment. Tell them what you want to do, how you want to accomplish it. Ask them for information. And if you want to talk through any ideas, we can sit around and I can have something to munch on while you guys ask me questions.
All right, I have another question.
Another question.
When you use the term deduction, you're referring to the year-end tax returns that we do and filling out the forms for reducing your income?
Right.
To get a deduction? Okay.
Right. Through the IRA, you don't need to do that because you would not have to claim it on your income tax. If you do it outside the IRA, then you're going to need to show a charitable deduction, okay? With the tax laws the way they are now, your medical expenses and your charitable deductions have to be at a pretty high threshold. I think it's something like $33,000 before you're going to exceed what you're going to get now as your personal exemption. So if you don't exceed the giving over and above your personal exemption, you lose that. So if you're giving money to the charity on out of your checkbook on Social Security income or retirement income that you're getting, you're losing the advantage of being able to transfer it out of the IRA and not have to claim it on your income tax. Okay? So it makes really good sense to do it that way if you are of that age. Okay? And if you're not, then there are other strategies that you can use by you can make the contribution to the charity in 2025, and you can do your 2026 contribution before December 31st, and you can take a double deduction in 1 year. You're just going to not do it the next year. So if you take that and do 25 and 26 all in 25, you can maximize the charitable deduction. You may get over the threshold that you need, so it exceeds your personal exemption. And then next year, you don't give it to charity because you already gave it to them, and you just take your personal exemption. Talk to your accountant.
You do it like every other year.
Yeah. You double up in 1 year. You know, if you're going to give it in 2026, you're just giving it, a little early in 2025. So you double up.
Question?
Yeah.
So next year, being turned 73 and we're required to take out the required, what time of the year is there a certain?
So you are over 70 and a half.
Yes.
All right. So you could take it now and you could use the QCD.
Wow.
Yeah. And I'm going to get to that. So next year, go ahead.
But I'm talking about.
The 73.
Yeah.
Required.
Yeah.
What time of the year are you required to pay this to this?
Before the end of so if next year you turn 73, you're required to take that before December 31st of 2026.
Okay.
So it's not the day, it's not your birthday, it's not January, it's by the end of the year. Sometime during the year you have to take that deduction.
Okay.
So another question. So the double up, how can you tell we don't have any advisor, we only have with the company, the Fidelity. How can we tell that person we want to double this year? But next year we don't want any. We're gonna double in 1 year. Next year we.
You do it. You call up and say this is what you want to do.
Oh yeah.
I can help you through that. And if you have Fidelity, all you have to do is call Fidelity and tell them that you want to move your 457 to an IRA. You know, if you did that before the end of the year, you could do the QCD out of there. Okay, for your charitable deduction. But you have to do it next year, but you can't do it unless it's an IRA. So if you're going to take the requirement distribution out of your 457, you might as well just change the letters on it and make it an IRA, not a 457. And there's no magic to it. It's just a piece of paper that it just flips it. That's all. Yeah, they don't sell it and reinvest it. It's just they transfer it in kind. So it just goes from this envelope to that envelope. There's no changes.
Can I make a comment about Canal Report Ministry?
Yeah.
Okay. So we sponsor a table at the gala, right, every year. And we take the money out of his IRA. So we don't have to write the check for $1,500 out of our checkbook, but we call our financial house and tell them we want a check made out for $1,500. And so it doesn't come out of our personal spending, it comes out of the retirement account. So that's a thought. And then, of course, there was the land. I think we're probably finished with land, aren't we? But we're going to be getting done with building. We're going to be getting ready for building. So it's an excellent way, if you've got a nice retirement account, to give money to Canal Report Ministry through that way, and not have to claim the income on your own.
Yeah.
As Mark said, if you're above the age of 73.
If you're going to give out of your retirement account. It saves you, and it doesn't cost them anything.
Right.
And they don't have to claim it as income. You know. Any other questions? Okay. Thanks. Appreciate it.